Well, the Feds did it again. As expected, in their November meeting, the Federal Reserve raised their rate by 75 basis points, which was what most people were expecting they were going to do. They've did this now in June, July, September, and November. Um, so they've raised it 75 basis points each time that they met. This is the first time in history that they have raised the rates this fast and this significantly. And they're doing this in order to tame inflation, which is at a 40-year high. So their intentions are to tame inflation. But what it's going to do is put us into a recession. And it's going to, I'm going to talk about three things that's going to affect. That's going to affect every one of us directly, that I'm going to talk about today with this because of their interest rate hike that they did again. So they raised their, again, 75 basis points on what they call the Federal Reserve's rate. That isn't the mortgage rate, but it affects the mortgage rate. Because what's happened is since they started raising these rates in March of this year, when they started raising the rates, the average interest rate for a mortgage was at 4%. We're now over 7%. And with this latest 75% basis point, I wouldn't be surprised if we get up over 8% because the mortgage rates have been going up almost incrementally the way with the Feds raising their rates has done. So again, this is what they say. They're claiming this is to tame inflation, which is at a 40-year high. What they want to do is make the cost to borrow money higher so that it cools off demand. They call it demand destruction. I talked about this in a recent video, but it's called demand destruction. They want people to quit buying things, so they're taking the cost of buying something higher. And unfortunately, that's really not what has caused this inflation. The inflation's been caused by our government spending too much money. That is what happened. And they've also just done things that discourage production. So now we don't have as much production and we have more people, more demand for goods, and it's caused this 40-year high inflation. So the Fed is going to try to take care of that by what they call demand destruction, and they're doing it by raising the interest rates. Now, they're not done yet. All indications are that they will probably slow it down a little bit. When they meet in December, they might only raise it by 50 basis points, but they are still going to be raising it, and they're going to be raising it into 2023, which means mortgage rates are going to go higher as well. I've seen some people talk about up to 10% mortgage rates, and at first I thought that was a little bit crazy, but now I see their point, and I did a complete different video on this. Will mortgage rates reach 10%? Most people didn't think they were going to reach the 7% that we've already reached, and I believe I see us going up to that 10%. But more importantly, how does this Fed interest rate hike affect you and me? So, first of all, it's really cost home buyers their purchasing power. The purchasing power for the average home buyer has decreased dramatically. And what I mean by that, if you were to get a loan in December for a $300,000 home when the rates were 3.11% at that time in December of 2021, you would be able to get that home for your payment approximately $1,200 per month. Doesn't include tax and insurance, but that would be your mortgage and interest payment, $1,200 per month. Now that we're at 7%, that same home would cost you $2,012 per month. So that's over $700 more per month in your housing payment. So that's $700 more per month that's going to be out of your pocket to be able to spend, even just for other necessities like groceries, your utilities, things like that. $700 less. So it's really taken the your home buying power, your purchasing power, and just reduced it dramatically. And that's at 7%. I haven't run the numbers yet for what will they'll be at 8% or 9% and 10%, but it's going to be considerably more that you're going to be paying per month for a new home. So that's going to crash the housing market. It just is. Home buyers can't afford that. And so they're going to stop looking for homes. People are currently looking for homes, and I'm a real estate agent, so I know this. People have been looking for homes, have already told me they're going to put their search on pause because they can't afford these higher interest rates. And it's unfortunately, it really hurts because people that were looking to sell their home, now I literally have to tell them, you're not going to be able to get as much for it as we originally thought when we were first doing the market analysis because the purchasing power of the buyer has gone down so much because of these interest rates hikes. So that's the number one thing that this affects. The second thing it affects is anyone that has a credit card and they maintain a balance on that credit card, The prices of because credit cards have a variable interest rate on them, and they're actually the most recent statistics was the average credit card is 19% interest. And that's actually the Federal Reserve didn't keep track of this until 1994, but that 19% is the highest it's been since they started keeping track of what the interest rates are. So, what that means is every month when you make your monthly payment, you're going to be paying more towards the interest than you ever have been compared to paying what your balance is. And again, what that does, it'll just literally takes money out of your pocket because every month when you were paying it, you were also paying down some of that interest. But now with the higher interest rates, you're paying more of it is just going to be interest, just money gone out of your pocket. So this is another way they're going to demand what they call demand destruction is that it's just less money in your pocket because when you pay your same bill, more of that's going towards interest than it was before. Again, the highest rate since they started keeping track of those things. The other part of it too is with your car loans. So your car loans are a fixed rate loan, but the average car loan now is at 5.6%, where at the beginning of the year it was only at 3.8%. So the demand for new cars is also going to start going down. Also, what has happened, unfortunately, both through just regulations, some supply chain, but and inflation, just inflation itself, the wages on everything going up. The cost to produce a car has gotten more. So autos are at one of their highest prices as well. The inflation on autos has caused the price of a new car to increase dramatically as well. So the demand's going to go down because the interest rates can be paying more to buy a new car just in the cost of it and the cost of financing that car. So those are three things that really hit home to really everyone. I mean, almost everyone has a credit card. Almost everyone has a car loan or want to get a different car. And then again, it's really going to hurt the housing industry, which, as I always say, is kind of the backbone of our economy. So that's what's happened so far. And again, the feds believe that by them raising the interest rate and they bring down the demand for goods, one of the numbers that they look at is the employment number. And they actually believe that a higher unemployment number is better for the economy because it'll bring down inflation. That's kind of just a nice way of saying, hey, we want you to lose your job. I mean, that's what unemployment is. People lose their job. So the Fed's not going to be happy until there's a higher unemployment rate. Until people literally lose their jobs and not as many people are working and not as many people have the opportunity to work, the Fed is going to keep raising their interest rate because they believe that that will stop inflation. If people don't have jobs, they don't have money to spend on things. I've said before in previous videos, I think that's backwards. I think what we need to do is they need more production. We need more production going on, and we need the government to quit spending so much money. The government spending money is what has caused this inflation. That's what has caused it. And so, again, as I keep saying, hey, this is where we're at. It's not a great place to be. It's where we're at, and hopefully we can all get this through together. If you like this video, please give me a like, subscribe. I got a lot of good content on my other videos. You can look back and see what I've been talking about with prices and inflation and such. So subscribe to the channel, give us a like, give me a comment down below. Tell me what you think and how this is affecting you. I'd love to hear how this is affecting you as well. I did a video just telling my own personal experiences about how this inflation is just literally impacting the price of the groceries that I buy every day. I'd like to hear your comments on that as well, because again, like I said, this is something I think we're all in together on. So please subscribe, give me a like, and comment down below. Thanks for watching.